We're going live.
It'll come up. Hey guys, welcome to the Red to Black podcast. We're going live, and today it's hosted by Werner and Mario, and we're discussing where are we in the market. Mario and I believe we are at the tippy top, as well as many other renowned investors and individuals on YouTube. So if we're at the top and this thing crashes, what do you do at the bottom? That's what Mario and I are going to discuss today. And I want to start off with an article from Zero Hedge of some of the bubble characteristics. And in this article, he gives an example of a tech business and where they ended up at the bottom, I think, of the dot-com boom. So an internet company that hit $90 per share. Here's a composite of what happened during the dot-com bubble burst. An internet company that hit $90 per share has slipped to $60. And investment banks are recommending it at $60 based on the internet has endless growth ahead. Buy the dip, right? What we're experiencing now. And the loss of a third of its evaluation makes it a relative bargain. The buy the dip crowd has already lost money buying every step down, but a 30% decline must near the bottom, right? Perhaps a 30% decline is the bottom in a risk-on market, but in a risk-off market, the eventual bottom isn't $60, it's $6 per share. In the optimistic, euphoric, this is a permanent risk-on phase. A $15 drop from 90.75 is a screaming buy. A decline to 60 is a literal incomprehensible. So Mario, talk to us a little about the psychological dynamics here and what you're seeing.
Okay, so we are very close to the end, Werner. I would, if I had a whiteboard behind me, I would draw this out in a different type of analogy. And eventually, when we have the Red to Black podcast studio up and we're live, we'll have some whiteboards so we can kind of draw some pictures. But I want to draw for the listeners a mental picture of a car chase. So if you remember back in the 90s or 2000s, they used to put up car chases in LA. It's not as popular as anymore because we have so many more things to do with our time, YouTube, BitChute, Instagram, et cetera. But car chases were really, really popular at one time in America. And what you would see is that car would start accelerating and getting up to speed faster and faster, be weaving in and out of traffic. And you wouldn't know when the end, this thing's going to end eventually. You can predict that. Everybody can predict that. You can get on and predict that car chase is going to come to the end. There's enough cops. There's helicopters in the overhead. There's multiple helicopters following this car. But when you really knew it was going to come to the end is when one of the wheels got knocked off, or they punctured a wheel, or they put out a spike strip, or it hit another car, it hit a barrier, it hit a median, and now it's still driving. Those rear wheels are still driving, but it can't steer anymore. It can't go. It doesn't know which way to go. That's when you really know it's about that, and that's happening right now with the stock market, with Bitcoin, with real estate. That's what's happening right now is the wheels have come off and this thing is about to tank. And I want to kind of go through. So that's, how do we know that? We are at unprecedented peaks in different evaluation metrics. We're at the top of the absolute, from here, it's only months. It's not years. It's not decades. It's not 5 years, 60 months. It's not 2 years. It's not 18 months. We're talking about months away. We're at these valuations, we're months away from this thing coming off. And it's not a 30% drop. It's 50, 60, 70, 80, 90. That's what you're going to see is you're going to see a quick drop to 50 and it's going to bottom out somewhere in the 60, 70, 80, 90%. Some things are going to be absolutely done. Some companies are going to be done. So Warner and I want to just talk through our steps or what we're going to do when we have those opportunities. So over to you, Werner.
So I want to give another example. It's funny that you mentioned that, the car example, because I was watching a YouTube channel called Ken Block. And if any of you are interested, you may not be interested in cars, but if you're interested in learning how a guy does exceptional branding, watch Ken Block. He built DC shoes. He's a world rallycross driver, or used to be. Now he's into all sorts of other things. He has a new company called Hoonigan. And the guy is he's just a brand magnet. Like, he just signed a deal with Audi. If you want to see an example of someone, in my opinion, who does branding the best in the US, it's Ken Block. And I'm not kidding. He is phenomenal at it. So on his channel, to up his branding, now his daughter, Leah Block, is now racing. And they're doing these like drag racing events on YouTube where they ask the best drag racers across the country to come and drag race them. And they had this one guy, I guess, who was really good at it. And he was in this souped up car and she was in her car, 14 years old, 450 horsepower. and she would get a bit of a head start because this guy was a professional drag racer, I think. But on the second or the third, I think it was the third one, they took off. And I mean, when you watch these cars accelerate, she was in a Mustang. I forget what he was in, but his car was just taking off. And all of a sudden, her car, imagine like this, she's taking off. Her car just started decelerating back. And you heard this pop. The drivetrain, bam, just went out. That's what Mario's talking. And I watched it. Imagine accelerate, and they were accelerating same
That's right.
speed,
That's
and then
right.
boom, and back off. That's what we're starting to see. We're seeing it in terms of DocuSign drop 40%. ARK, supposing Kathy Wood's fund, ARK Investments, like 89% of that fund, they're in bear markets. So you're
That's right.
starting to see Elon Musk is selling. All these guys are, you're at this euphoria, up, up, up. So what do you do as you see the wheels coming apart and you're aware of it? What do you do? Over to you, Mario.
Yeah, 30% cash minimum. You go to 30%. You don't exit all your positions, but you build that 30% cash position, which acts as a shock absorber. So as everything's getting dumped into, you can't get rid of stuff fast enough when it starts happening. So as these guys are as this market has taken off, now the wheels have come off. You see Chinese real estate companies bankrupt. Why did that happen? Because they shut down factories in China. The whole thing is falling apart now. And now we're months away from this thing actually going completely diving. So have that 30% cash. Go to 30, 1/3 of your position cash. Go to 30% cash, 33% cash. Keep the best companies, keep the winners that aren't overvalued, keep your best companies at 66, 2/3 in the equity market or your real estate portfolio or businesses that you can't sell quickly. Stack that cash and build a list. Have a list ready to go to execute. Warner has a list of companies. I have a list of companies, 15, not the exact same companies, but similar industries, things we really would love to have long term if they were the right price. Because the first thing you're going to do, step number one is when things tank, is take that 30% and deploy all 30% into a small list of wonderful businesses in the public equity markets. That's the first thing that tanks, is the public equity markets. Over to you, Warner.
So public equity markets go down first. Let's say the public equity markets typically go down 80%. Real estate goes down 40%. Now, nothing is set in stone. Who the heck knows how far real estate can fall? But the reason why real estate doesn't fall as much is because it's a much harder market to get into. I mean, think about buying a house or even a commercial asset. It could take you, from what I've seen, the longer deals, 9 months to a year, and then 9 months to a year to sell. In the stock market, it's like, open up your computer, boom, 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 buy, oops, sell. So it can move a lot quicker. It can go up quick and down quick. So in terms of what Mario is saying, how do you determine if you have, what's the good quality business and the bad quality business? Well, number one, you look at cash flow, because Mario and I always recommend, like, what's the business that's going to pay you the most cash flow? Now, this is something you should have been doing a long time ago, which is called stress testing your businesses in your whole environment. But look at the businesses that pay. It's really simple. Just look at the businesses that are paying the most for the share price that you purchase at, whether if it's 10, 15%, and then look, in your opinion, from what you're seeing in the market, will these businesses maintain their growth? For example, everything's going towards, whether you like it or not, it's going towards AI, robotics, online finance, online healthcare. Are your businesses in those areas? Like Mario said before, if you're in a commodity business like a utility, which they'll just continue to pay out, did you buy that at a rock bottom price and it's just continually paying you? So start looking who's paying you the most. Also consider, even if a business is paying you a good amount, did you buy it at the mid to high? It's not going to pay you a lot. Most of the businesses I've seen, with the exception of a tobacco company, Altria Brands, they're all paying. I've not yet to see one except for maybe Texas Instruments, but no, they're all around 2%. You maybe get a 4 to 5% bump in one or two businesses and 7 to 8% in Altria, but we don't do tobacco. But at the end of the day, the businesses are just a hair ahead of the treasury markets, right? What's the 30-year treasury right now?
The 10 years about 2.4% or 1.4%.
So they're above. Most businesses are right around the treasury or a little bit better. The good quality businesses. If you look at all the dividends, I mean, I look at them all the time, 2%, 2%, 1.5%, 1%, just down the board. So start saying, if you didn't buy a business at the bottom and it's not paying you, like if you bought Texas Instruments in the bottom of 2008 for $12 a share, you'd be getting a 25% return. Hold on to that business. Now, these are only our recommendations.
Exactly. So when you let me put it in different terms. Absolutely correct. When you get those great deals and you buy in, what you want to calculate isn't the current yield on investment, but your prior yield on investment, on initial investment. So Texas Instruments, or let's use Oracle as a better example. Oracle is only paying 2% right now, 2.5%, 3%. But when you bought it 10 years ago, 15 years ago, your yield on initial investment is 12% or 16% or 18%, depending on what you paid for it. And that's where you don't want to exit that position. You'll never buy back at that level. So keep your return on initial investment is very, very powerful. Compounding that, you'll never be able to get that number back up there. If even when it dips, it's not going to dip back 15 years. Oracle will never sell. Now, Oracle is going to tank, just like everything else. When people hit the exit on mutual funds, everything gets sold, the bad and the good. And that's where you're going to get those opportunities in those great businesses. But if you own that great business right now, don't sell that business. Move out of your mutual funds. Like, this is a great time. If you had a third of your money into mutual funds, but you had 2/3 into actual individual businesses, this is a great time to exit mutual funds right now. But hold on to your winners.
Apologize if you can't hear me because there's a compressor going off below me or around me. I don't know if it's a paint compressor or a generator. I don't know, but it's you'll hear.
It sounds all right on my end.
Okay, great. So that's that. Guys, when we're on a live stream, things happen. So what I want to
go ahead, Warner.
So what I want to say about that is the simple way to look at business, and I talked about this in another channel I have called Red Black Academy. Plug in the Red Black Academy there. And what I want to talk about is when you're looking at your cash, your hard-earned cash or your value that you've made, the way you want to look at anything you're investing in, could I take that cash or that value in any business and could I pull it off and make more sometime? And that's a probability thing. It's up to your own discretion. We can't tell you how it's going to go. But if you're making 2%, in our opinion, because this is all our opinion, at the top of a market, and you're going to have one of the greatest crashes we've ever seen, you're going to make more, in our opinion, than 2%. So our recommendation, what we would do is we'd pull that cash out, put it in a safe spot, and then wait so we could buy a better asset or the same asset at a better price and make 10%. That's key. So looking at your cash, can I make more on that cash somewhere else? That's how you want to analyze that's the simplest way to analyze any business, any investment. You don't need fancy charts. You don't need Excel charts. This lump sum of cash makes this amount right now. If I take it somewhere else, yes, there's going to be a carrying cost and a cost, right, that's being hit on by inflation every month. But can I make more by getting into a better investment through my assumptions in the future? Go ahead, Mark.
Yeah. So the second thing we're looking at is actual individual businesses. So after you deployed the money into equities, you've taken all your 1/3 of your money, you've plugged into equities. Those equities are going to be generating dividends, and there's still an opportunity because you're going to be every 90 days. You have another problem. You got more money. Plus, you're saving up money if you have multiple streams of income. Second thing to look at is individual businesses that they're trading on a private market, or they're for sale. People are scrambling to raise capital. Because the economy is diving, and go out now. Those deals, go out and look for those deals, or look at generally what you want. So Warner and I are very interested in the food and beverage industry. So we're constantly looking or thinking about things to buy in those spaces, and those deals are going to take you at least 30 to 60 days to set up. Now they're gonna almost follow the equity markets, but they're a lot slower transactions. Warner and I can do those deals. Let's say we can do a $10 million deal. We could do a $15 million deal, but it's going to take us 60 days to go out and raise that capital. We're going to have to put a little bit of our own money in there. We're going to have to each come up with, let's say, 2.5%. So Warner and I are going to put in 5. There we go. And then we're going to go raise, another 30% equity. So we're going to be 35 into this on private equity into the deal, and then we'll go out and find a lender that wants to give us an opportunity to run the business. So that's the second thing I'd look at after I deploy that money into my little list or our short list of publicly traded companies. I'd look at private companies to go out that need help. They're scrambling. They're trying to keep alive, and they need equity investors. They need capital. They need to keep this thing going, and that there's opportunities. They will definitely, there's going to be a ton of stuff for sale. Warner and I can't buy it all. We're too small. We don't have enough money. We'll run out of money before we run out of ideas of what's about to happen.
Great 2 points. I want to delve in a little bit deeper about like skin in the game, because when you have a bunch of cash stacked up, it provides opportunities like Mario and I have talked about in the past. And so your number one opportunity, which is the easiest wicket, like Mario said, is you just get online, take that money and plow it into a stock, right? But okay, let's say at the bottom, it's only paying 10%, but you're like, well, I want to make 20, 30, 40, which you can do 100%, 500% in a private business at a bottom, which you can do. Now you're going to go to this business, right? And you're going to say these individuals, and I would say the transaction will go quicker if they really need the money. If they're in a dire strait, they give me that money, let's go. The only thing that's going to slow you up is going to be, like Mario says, the lending side of the house. And what the lending side of the house wants to see, I was talking to my friend Chris Montes, who's a mortgage banker, and he deals with finding mortgage loans for commercial properties. And he's saying one of the biggest things lenders look for is how much skin you have in the game. So if you're going to go into a property, the lender may be like, well, maybe it's 5%, but the lender's like, oh, we're at the shitty market. I want to see 10%, right? So it's really depending on who you find at the bottom of the market. But the key thing here is that you have the cash to show skin in the game, because then the lender's going to go, we're in such an insane market. I want to know that you're not going to bounce from this.
Right. And as things are getting crazier, they're going to want to see more skin in the game. So
yeah,
during the good times, you might get away with 5 or 10%. During the bad times, you're going to need 35%. So Warner and I are going to need to come up with 5%. We're going to need to go raise 30%, 35, and then we're going to have to go ask for 65 coming from the banks or from, at least probably 2 capital partners. They're going to rate, probably one's going to do, 30 to 40%.
And a smart lender may go, well, I want to see how much you two have in the game.
Right.
Like that's what I would do. I don't care what your equity raise. See, the equity raise helps, but I want to see how much. That's why it's important. Why I'm saying is why it's important to have cash. I want to see what the principals have in the game.
Right. That's right.
If the principals have like a little bit, and then
you're going to need to get at least 5% in the game.
Yeah. At least be like, at least be. So that's a metric. See right there, guys, what he gave you, that's a metric. So you want to know your numbers. You want to know number one situation, things tank. At which price am I going to buy this stock? When do I say go?
Yep. Right.
That's number one. Number two, what's the deal size? Like say I'm looking for a $10 million business. Normally it trades at 50 million. Right. Okay. If it's $10 million and we're going to do 5%.
That's 250 a piece. That's 500. That's 500,000. Yep.
500,000.
Yep.
So 5 million, right? Yeah. I did the note.
10 million. Yeah. Slow down. Warner. 10 million.
10 million, right? 1 million, 500,000. Now, yeah. So you could even do equity raise, like Mario said, where it's 250, but you could lower that down if you bring in more equity. And this is just something you're going to work through the lender. But the key is you want to say, okay, I know I require 250 each. Let's bump it up, say 500 each, just waiting, yep. 500 each.
So that would mean we can go hunting. So we're going hunting for a business. If we come up with $1 million, 500 each, we're hunting for a $20 million business. We're out there looking for a $20 million business, but it's going to take time. Those deals are going to take 60 days, 90 days to close. Even a distressed deal, distressed debt, those are going to take time, where the public markets are much faster transaction. Put the money to work first in the public markets, go out hunting for that $10, $20 million deal. And then the third thing to look at is good property, good real estate that's not cash flowing. That could be a vacation property in the Tetons, or that could be a multifamily property in College Town that people bought too high and it's not cash flowing. They're not able to make their loan payment, or they're barely able to make their loan payment. It's not quite cash flowing. Those are the type of property. That's the third thing to go after. And those are also longer transactions. When it takes longer for that to happen, it's slower. People are going to get 90 days. They're going to get 6 months of a moratorium on eviction. It's going to take a lot of time. So those properties that are not cash flowing, or vacation properties where people are pulling, hey, I'm canceling vacation this summer, I'm canceling another vacation, I'm canceling. It's going to take longer in the economy for those things not to cash flow, because people are going to be able to scramble and make those payments.
And one thing you want to look for before we end this podcast, we'll go a little bit over the 20-minute mark, is look for the gaps. And the way you'll know the gaps is, like, for example, the institutional guys aren't going to go for a certain level, right, deal.
No.
And then
Nope.
the smaller houses aren't going to go for a certain level deal.
Right.
Look for the place where the price just keeps dropping. No takers,
Right.
no takers.
That
no
20
takers.
to 50 million, the 20 million is real hard for mom and pop to come up with. You've basically eliminated individual investors, that 20 million. Institutional guys, it's not worth their time to do deals less than probably 100 million, but 50 million, they're not going down into that. So that's a sweet spot. That like 20 to 50 million dollars is a sweet spot. Too big for the mom and pops, too small for the big boys.
And then you have all the other mid-level shops that overbought, and they're getting smoked, and they're getting equity call. It's just getting nuts. So yeah, start looking. Here's the thing. This is the great thing about cash. Mario taught me this. When you have cash, it's like you just show up to the safari. And I apologize that you aren't hunters. You just show up to safari and you just have like
it's open
you
season.
and your safari vehicle, and then in the back is a pickup truck full of armament.
Yep. You got ammo. You got ammo and guns.
You got ammo.
Yeah. When you're scrambling to try, there might be great deals, and you try to get to, you're like, oh, I know how to run that asset. I want that asset. I need that asset. You got to find lenders, and that's your problem. Is these people are not going to be, banks are not going to be optimistic in these situations. You can still do it. It's going to take time, but when you have cash, man, you can get things done. Absolutely.
Yeah. Okay. Well, thank you guys for listening, and as always, if you're not a subscriber, like, comment to get this to the world. Subscribe. If you think someone else could get value from this episode, which will launch in about a day, so come back and check this out. If anyone could get value from this, share it with your friends and family. We appreciate it, and we look forward to connecting with you in the future.